again, everybody. By far, the biggest development in international tax over the last decade has been the OECD's BEPS program, base erosion and profit shifting. Basically, the OECD is saying multinationals have been eroding the tax base of countries and have been shifting profits overseas to low tax jurisdictions. That was absolutely true. There isn't anything light about it. But everything else that they did thereafter is basically one big lie and one big political spin that I profoundly disagree with. If you look at how it started, it was completely politically motivated. The people who were running it, Pascal Saint-Amand and Marlies Ruiter, two of the leading figures in the core BEPS team, were devoid of actual knowledge and understanding of international tax. They had no prior experience in large corporations or in advisory firms, yet they were arrogant enough to proceed with their plans because they were convinced that multinationals were profit shifting and eroding tax bases, and they were right to do so. But what they completely forgot is that doing business cross-border is highly tax inefficient. If you are simply in one country and you make losses in one company and profits in another company, then in most countries you're allowed to offset those profits and losses against each other. Within one country you typically do not have withholding tax. Cross-border, you very often have withholding tax, and very often your withholding tax is not creditable. It's a bottom line additional tax cost. I can give you many examples of one-sided corrections after a tax audit cost that will be deductible if it is in relation to another company in the same country, but if the other company is not in the same country, then suddenly those costs can no longer be deducted. There's a multitude of examples that can underline that doing transactions across border is inefficient from a tax point of view. What multinationals were doing is they were balancing that with base erosion and profit shifting. They would sometimes double dip on interest deductions. They would present a loan agreement as an equity instrument in another country and therefore don't recognize the interest income pickup. You could argue that that was not the intent of the law, but if you stick to the law in both countries, there is no higher standard than the law. Countries have abuse of law provisions. You have Supreme Courts that will interpret the law, but they will only interpret the law of their own country. So what they set about is a project basically to eradicate base erosion and profit shifting. What they didn't do is they didn't do the flip side. They didn't do anything to make doing businesses cross-border less tax inefficient. So therefore it was very unbalanced what they did. This whole project had a massive political support by the G20. Obama himself promoted this, and this was shortly after the global financial crisis, so it was just perfect because, you know, which politician wants to be held accountable for their own behavior or the behavior of previous politicians? That doesn't exist in the manual for politicians. It was very convenient that they could put the blame on multinationals, and the OECD gave them the arguments for that. So the G20 were fully behind that. And if you see the spin in the opening document where they announce the BEPS project, it goes on and on and on about that multinationals are not paying their fair share of tax. It's literally, you know, every other sentence mentions the word fair share. Then if you go to the annexes of that first report, there's an Annex B that lists all the existing, at that time, 2012, all the existing scientific, academic research into the topic, whether multinationals pay their fair share. And there were a lot of reports already from independent organizations as well as from trade organizations or consultancies. The author of that Annex B was clearly somebody different from the author of the general paper, because the author of the annex basically concludes the evidence is inconclusive. We can't really say at this point in time whether or not multinationals are paying their fair share, but we are the OECD and we're going to research this and find out, and we're going to come back to you in our final reports that were then finally published in October 2015. Report number 11 was supposed to give the data, so to provide the evidence that indeed multinationals did not pay their fair share, but surprise, surprise, drum roll, there is no more mentioning of the word fair share in report number 11. But with that drum roll, they're announcing that they've proven that base erosion and profit shifting behavior exists among and is prevalent among multinationals. Well, everybody knew that. That was never a question up front. So basically they've not proven what they set out to prove. It goes further than this, because it's actually, it reaches a level that I find scandalous. Not only did they leave out completely that doing business cross-border is inefficient and they didn't do anything to ameliorate that, they also suggested that the BEPS program would be good for developing nations. Yet if you think of the end result requires a lot more substance, and companies from the major OECD countries do have that substance, so they can hold on to their treaty positions. But companies from developing nations, they typically do not have that international substance. They typically would like to route their transactions via a country like the Netherlands. Why? Because those developing nations were always an inbound country. Capital would come into their country, so when they negotiated their tax treaties, they would negotiate treaties with high withholding tax rates. But now the OECD tells them, no, you cannot treaty shop via the Netherlands. No, you have to use your own treaty. But that's a very unattractive treaty because it has very high withholding tax rates. So now suddenly if there's a company from Israel, from Thailand going into Germany, Germany can levy the high withholding tax rates of that treaty with Thailand, for instance, rather than allowing the Thai company, which is typically not a very big multinational but more small and medium-sized enterprise, to shop via the Netherlands. So it's actually not at all, and it was very misleading to say that this would be for the benefit of developing nations. Another point of criticism is it's completely ignorant that they treat equity structures and debt structures alike. In an equity structure, the return on your equity investment is dividend. The dividend was never tax deductible in the source country, so that the ultimate owner tries to limit double taxation. I think that's only fair, that's only normal. In the case of that structure where interest was deductible in the source country, well, there I agree with the OECD. Then you should prevent treaty shopping, because you may otherwise end up in a situation that it has been deductible, but there's no taxation anywhere. I agree with them on that point, but they should have made a distinction for equity structures, which they didn't. They said, no, thou shalt not treaty shop, not for debt structures nor for equity structures. If you don't have a good treaty yourself, well, tough luck. Yeah, but the big OECD countries, the original 30-something OECD countries, they are in good shape and they're really the winners here. During this whole process, it became clear that the whole focus on proper substance and using your own tax treaty actually doesn't work in the private equity industry. Who are some of the biggest investors in private equity structures? Those are actually government pension plans. And so during the whole BEPS project, it became clear that, especially for a country like Luxembourg, well, Luxembourg is not a country, it's basically a village with 450,000 inhabitants, but a lot of the private equity structures are run via Luxembourg. Why? Because you could get tax rulings in Luxembourg that perhaps you couldn't get in other countries. So there was this big dilemma and standstill moment where they basically had to grasp for air and say, how do we solve this? And they really didn't solve it. Just to wrap up, this discussion actually goes back a long time. And back in 1923, during the League of Nations, which is sort of the predecessor of the United Nations, there was a committee under a Dutch professor, Professor Bruins, who had to decide and had to advise the League of Nations which country should have the primary right of taxation on income from capital. Should that be the source country, so where the capital was invested, like a country in Africa, or should that be the home country, like, for instance, the US or a European country? And the committee Bruin said, well, okay, there are arguments pro and con both. Well, we have to make a decision. Okay, let's give the primary taxation right to the home country, to the OECD countries nowadays, basically. If they had made a different decision at that point in time, which I think you could defend under very good arguments, then this whole discussion would never have existed. So the OECD should also look at its own history and think about its own responsibility. I've written about this in International Tax Review in 2016, shortly after the final BEPS reports came out. Now, like I said at the beginning, base erosion and profit shifting program of the OECD, including the multilateral instrument, is the most important development in international tax of the last decade, and it has changed literally everything. And so it's very important for you, if you're making a step overseas, to take this into account. If you want to read more about this, an article that I wrote is called Is the Use of Holding Companies and Finance Companies Inappropriate? It was published in 2016 by International Tax Review. You can find it online. I hope this has given you a quick summary of this important development. If you have more questions, please contact us.